All right, so we're going to jump into module two for our course. This is chapters 3 and 4. So we're going to cover both of those chapters homeworks in this one. So starting with chapter 3, you see here we just had an initial public offering or IPO. We had explicit fees. And then once we paid that to the underwriter, we noticed that the offering price was 42 and then jumped to 45.50. So what was the total cost? We have our explicit cost, the check we wrote, right? That's what we mean by explicit. We actually paid this out. And then we have the implicit cost that we have from the underpricing, right? So this underpricing is money that we could have received as a corporation, but we did not because we priced it too low, right? Now all of that cost that we have, is that a profit for the underwriters? No, a lot of that is profit for those initial purchasers, right? Those guys that came in on that ground floor and they took advantage of it. But you see the write up down there. There's some reasons why this seems to occur, and one of those is just maintaining liquid markets. Again, this problem here has multiple sections to it. But if you notice, this person goes out, they open a brokerage account, and then they take out a loan from the broker. This is what margin is, right? When you take out that type of loan. So what is the margin? If you see there, the answer for A, the stock is purchased for 50 times 200, and then they borrow the 3,300 total. So that's the margin. If the share price falls, what's the remaining margin? If you see there, the remaining margin would be 4,502. You see how I calculated that? If the maintenance margin is 30%, will they get a margin call? No, right? Because they're still above that 30%. They're actually, at this 56%, right? And then the rate of return, though, is negative because, of course, they lost money. The thing to notice, though, is the share price fell from 50 to 40. So that's about a 20% drop, right? $10 from 50, right? So the share price fell 20%, but their rate of return is negative 32%, right? Not negative 20. And that's because margin magnifies your gains, but it also magnifies your losses. And so in this case, those losses get worse. Here's chapter 3. Again, it's another margin question. I'm going to let you obviously read over the write-ups for the answers, but just understand, again, this is that margin position, and then you can get a margin call because you have fallen below that maintenance margin requirement, right? And so what they'll do is the broker will call you up, and if they can't reach you, they already have your authorization to start selling stock to close out positions, and they'll start doing that. So it's better to go ahead and take the call and make sure you get everything fixed the way you want it. But they will fix it on their own if they need to. Okay, and here's problem 4. And if you notice here, you see the buy and sell orders. These are limit orders, which you tell them, I will not pay more than this price, or I will not receive less than this price, right? That's what makes it a limit order as opposed to a market order. Right. And so when market orders come in, they get balanced against those limit orders using the best price, whether you're buying or selling. Right. This is a legal requirement. You have to give your client the best price, even if you're holding it. So often what will happen is, even if I'm normally selling it a little bit differently, if someone would fulfill that, a lot of times I can go ahead and drop my price to fulfill the order. And that's fully legal as long as you are getting the same price. Right. But me handling it internally may save me some transactional costs. And so I'm better off doing that. So that's fully allowed, but I can't sell you my stock when there's a cheaper one out there. Okay. And then here's another one where we're looking at price changes in the stock and what that return would mean for us, particularly when we're on margin. And then also, what would the price need to move to for us to receive a margin call? All right, and same type of question. Initial margin, right? That's what I have to put in at least to open it up. Just understand that initial margin is going to be higher than maintenance because you got to let you want to have a little bit of a cushion there. That way, if the price were to move against you, it will. And then once you hit that maintenance, they will give you that margin call. And then this is another margin call question where, again, we solve for what would the price need to fall to for us to receive a margin call. Okay. And so a short sale is when you borrow someone's shares and then you go and sell it. And so that's perfectly fine to do, but then you have to go back and repurchase it. So this person, they short sold it, and then there was a dividend that should have been paid, so they'll have to make up for that as well. And then they have their total cost to cover the short sale, and then what would be their net gain. So they go through all of this, and then what is the total gain? And you see that there. And this problem, if you notice, there's a bit going on. There's 5 different questions. So I'm showing that one here. And then on the next slide, I'm going to show you the solutions. Obviously, feel free to pause, right? And everything that you need to do to read over this. It's hopefully it's very straightforward. We're just looking at, the value of this portfolio as these changes occur. Okay. And then here in chapter 4, we're starting to look at like mutual funds, open-end and closed-end funds. So this is an open-end fund. It's got a front-end load, right? So that you pay that up front. That's the sales commission, right? And so that would tell you what you actually are the offering price. So the value is that $11.20, but they're going to charge you $11.79 because you have to make up for that load. Here's a portfolio made up of 4 stocks, right? And so what is the NAV, the net asset value? Well, you just calculate what is the total, value held by these funds, and then you adjust for fees. Okay. So an open-end fund is what we normally think about with stocks because they're open and that things are being created and destroyed as needed to balance this, fund. With the closed-end fund, it's created and then it trades independently because it's closed. So while the regular open-end fund that we normally think about, we just calculate the NAV and then that's how we're going to calculate what the sales will be. In this case, the sale price for this bundle of securities can deviate from the NAV, and that's what you see here is this particular one is selling at a discount. Here's another closed-end fund type question. If you notice there, just looking at different holding periods and well, looking at the difference actually caused by some of those distributions. All right, and then another NAV type question. Okay, and you see here the way we calculate rate of return would be like we would for all of our other investments. What's the change in our position divided by what we paid to initially get into this? And then turnover rate is just how much we're changing the stocks, right? So you look at what we sold, right? And then divided by the value of the assets. And that tells you how much of the portfolio we sold in that year. In this case, is a little under a third, 32.5%. And this, we're looking at 2 different types of funds. One has the 12B1 fee and a low expense ratio. The other one has a front load a front end load, but then they don't have the 12B1 fee, and their expense ratio is lower, right? So you pay a higher a higher price up front, but then lower maintenance going forward. And as you see, the longer that you're going to hold that fund, the less important that front end load becomes. And then here's another turnover type question. You got the total assets. You sold 411 million, so that's the turnover. 411 divided by the 3.3 billion. All right. There's the same type of thing. We've got a front end load, and then we're going to calculate what our rate of return is after we account for that load and the expense ratios. And then this one, I'll try to just get that on one slide for you. So of course, pause it as you need to, go and read through that. But just trying to show you, these annual rates of return, where again, having that, going longer and longer periods of time, so your annual rate of return is changing. And that's what's going on is the portfolio looks a bit different because that load gets stretched out over more and more years, right? And so it's easier to have a nicer return the longer you hold it, and that's why a lot of mutual funds are thought of more as like the buy and hold type thing, because it minimizes those fees. All right, so that's it for module 2. Module 1 and 2 make up exam 1. So chapters 1, 2, 3, and 4 will be the first exam, and that exam is located with all of the other links. So good luck.